Okay, we are back here on Kiosk Toronto. Thanks for sticking with us. We have with us now John Klotz. I have to do this, John. BA, CFP, CLU, CHFC, RHU, TEP. That's a lot of degrees, professional designations. You're the president of Northwood Life for a reason.
Well, thank you very much. Now, before I mention that, I just want to say congratulations on your show.
Thank you.
Great, way to go, and it's great to be here. But yeah, I mean, Dave, you know, if you want to be successful in this world, you have to study a little bit, and you and I are both guilty of that.
Yeah.
And
well.
so, yeah, I've done my bit. I've tried to learn about the business, and the best way is to crack the books.
Yeah. Well, you're in a great spot now, I think,
Thank
at
you.
Northwood Mortgage Life Insurance. They're a big mortgage company,
Yeah.
of course.
So Northwood Mortgage, which is my partner, is the largest independent mortgage broker in Toronto. We're one of the. And what they did with me is we set up, they wanted to set up an insurance brokerage. So we partnered,
Right.
and that's what I'm doing. I'm running their insurance and insurance brokerage, and also working with a lot of clients regarding investments as well.
Yeah, that's terrific. So today we wanted to talk about the seniors crunch.
Yeah, and
Or no, not the senior, the retirement crunch.
Retirement crunch. And thank you for, like I said, it's a great topic. I've been a financial advisor for 20 years, and you know, when you do something for 20 years, you talk about this age 65 thing that used to seem way out there. It's not so way out there anymore for me and my peers. And you know, if you think about it, the average 35-year-old has about 360 months to plan for retirement. It's not an inconceivable period of time.
It comes.
It comes,
yeah.
and you know, 35 turns into 45, and suddenly you're facing it. And the crunch is that there's really only 3 options to accumulate money, and one of them is the government benefits, and I'm going to talk about that a little bit. And secondly, there's what employers are doing for people, employee plans, and thirdly, there's your own assets. Now, just addressing the employer benefits, and again, I've been in this business for 20 years. There's not a lot of employers taking care of their employees through pensions, especially in small businesses. So,
that's true.
You know, and you know that. You're seeing a lot of business owners say, you know, to a large extent, you're just be happy you have a job and you're on your own.
But the big ones are good. Like they do these sharing plans, which make you feel like you'd be crazy not to buy company stock or whatever because they're putting in a share. Like when you buy, they buy for you.
Absolutely, and those are great, and on a bigger scale. So you look at a lot of government employees; they have great pension plans. Teachers have great pension plans. But we're talking about the guys working in private business. Sometimes they don't have access to that. But that's okay, and you're absolutely right. If you can take advantage of a stock purchase plan or some sort of pension plan where the employer is matching, it's all great. But we're not seeing a lot of those. The other thing is, if you look at government pensions, like what you get from Canada Pension Plan, CPP, if you look at the amount you'll receive, it's about $17,000 a year between that and old age security. Poverty is $19,000.
Right. So if that's all you're living off, you got a serious problem.
Exactly.
Yeah.
And then you deal with, now you have to do it on your own. And the problem is, and you and I can relate to this, you only have so many years to work, right? So we just addressed it. And what if you have a couple of kids? Now I know you have a couple of kids, and so do I. They're not cheap, are they?
No, kids are not cheap.
They are not. And I know, it's no offense, Josh. But anyway, but they're not. And so the problem is you've got a limited amount of time to work. You're maybe putting your kids through private school, who knows, or putting them through regular school and hockey and all, and any other extracurricular, and there's not a lot of money left over at the end of the month to plan properly.
That's very true.
Retirement. So it's a crunch. So that's what I wanted to come and talk about.
Okay, so that's what you mean by retirement crunch.
Yeah.
It's like it's a crunch. It starts from the beginning. So it's a good idea to pay attention before you're like 3 years away from retirement.
Exactly, exactly. So there's some options here, you know, what you can do. And, you know, you can start a tax-free savings account. And those have been sort of bandied around, and those are great options. There's RSPs and there's personal savings account. So what I thought I'd do today, if it's okay with you, is maybe talk about some of the RSP rules and maybe some tips about how you can maximize that.
That sounds good. Tell us about it.
Okay, so as you know, there's some rules about, let's talk about RSPs. And I don't know if everyone knows exactly how they work, but just briefly, if you don't, an RSP, basically, if you contribute $1,000 to an RSP, it will reduce your income by that amount.
Yeah, it's a great option. And you get the tax deduction.
Exactly, and then it accumulates tax deferred
right.
until retirement. Not tax-free, tax deferred. So people love it. A lot of high earners like the idea of contributing to an RSP. The rules are fairly straightforward. You can contribute for 2011 up to 18% of your 2010 income.
Okay.
So they're always going the year back. You can always carry forward, which is great. From 1991, there's a lifetime contribution limit, and there's all sorts of of about $2,000, and there's all sorts of great things you can do. Spousal RSPs, which means you're splitting.
And and the more money you make, the more you effectively get back as a tax deduction if you're in a higher tax bracket, right?
Correct.
Right.
So these are some of the rules that a lot of our clients are sort of looking for. And again, as you know, the deadline has come and gone, but the idea is to continue moving forward. It's not over just because...
Deadline for 2010 is gone.
Yeah, it's gone. But now, now's the time to really get down and plan. So what I thought I'd do is I'd talk about, okay, those are some of the rules. Maybe we could talk about some of the tips.
Tips.
Okay. So I think an excellent tip is to start early. So we've got a scenario. We've got a 25-year-old contributing $200 a month and a 35-year-old contributing $200 a month. It's the 10-year gap. So the 25-year-old contributes $200 a month at an 8% interest rate, and at the age of 65, it's worth about $1.2 million.
Not bad.
The 35-year-old starts the same program, and at 35 instead of 25, $200 a month, but he's only worth $400,000 at the age of 65.
So those extra 10 years made a big difference.
Think about it, $200 a month times 12 months in a year times 10 years is 24 grand. Cost you 800,000. So you can even take it, you can look at a 45-year-old and a 55, and I have this really ugly graph that looks like a sharp decline.
It's kind of depressing.
It is depressing.
If you're 45 like me.
Exactly. And that's the comment I get. So I show this to a 45-year-old, and they say, oh my God, that's the most depressing graph I've ever seen. No, not true. It's not that it's depressing. It's just, if you haven't started it, now's the time. That's all.
Right.
So the whole thing is to give yourself a sort of time period to accumulate these assets. And by the way, in 20 years' time, you can accumulate all sorts of dough, and there's different ways to do it. But this is just sort of, as I mentioned, the trap.
So start early.
The earliest
Tip number one.
And if you have children, and you're saying to yourself, why didn't I do this? Maybe the idea is to talk to your kids and say, hey, you know what? You should start this as early as you can. Because sometimes, and it was very interesting, your last guest talked a lot about mentoring. About mentoring children in school. They don't teach financial planning.
That's true.
In school.
Yeah.
You and I learned it when we got out into the real world and we started budgeting.
Yeah.
They really should teach it. And you really should. It's one of those things that's coachable.
Absolutely.
So okay, fairly straightforward. The other thing, another great tip for people, is to involve themselves in some sort of monthly contribution plan. Now, like I said, I've been doing this for 20 years, and I've experienced some ups and downs in the market. A perfect up and down was 2008. Now, I assume you lost money during the market crash. And
lost a few dollars.
Yeah. Okay. So the idea is you don't know,
but it's recovered.
It's recovered,
right,
and that's
like it was a good year last year. Where things have really
phenomenal.
Yeah.
People have almost forgotten about that. I haven't forgotten it, and I'm going to actually talk about that because there's ways to deal with that. There are things like that will happen again. There will be crashes, and there are recoveries, and the older you get, the less easy it is to deal with them. But that has been forgotten because everyone's recovered from their money, but I have not forgotten it as an advisor because it's a really important point.
Forgive, but don't forget.
Well, yeah, just remember it, there will be other major corrections in the stock market. Historically, it's happened. It's not a surprise.
So the point of doing it on a regular basis is what? I mean, if the market crashes, you're still going to lose 20, 30, 40% of everything you've ever put in.
True, but you can at least mitigate some risk because, in fact, The idea is you don't know when and how the market is going to react.
Right.
The idea is to do something, at least it's disciplinary too as well.
Sure.
It's the idea of taking a fixed amount of money and contributing to it on a regular basis. Makes a lot of sense.
Absolutely.
So
and then you get to take advantages, like when prices are lower, you're still buying in, so you're lowering your cost, you know, what do they call that, dollar cost averaging or something?
Dollar cost averaging.
Yeah, remember that from 20 years ago.
So, and it's still relevant. Like the stuff you learned 20 years ago isn't wrong. It's just, and everyone, and actually, I want to talk about 2008. In 2008, one of the things the media did, and you and I both are involved with the media, is that they took advantage of this immediacy of it. 2008, if you were involved in that market crash, you were convinced during that time that you and I were going to be living in huts. That the market had completely collapsed, everything had fallen apart, Bear Stearns, all that sort of stuff.
Yeah, the media tends to do that.
They ran with it.
Not you and I, of course. But
never, no. But I'm just saying there's this immediacy. But you learned something 20 years ago about contributing every month. That actually still makes sense.
Sure it does.
Even though there's immediacy of all the events that are taking place.
For sure. Okay, so regular contributions was tip number 2.
So, and the other thing is properly diversifying your portfolio. So if you, and I just have made some notes here. So for the past 10 years, Canada's been a great place to be in. I mean, my goodness.
Sure it has. It's been incredible.
What an opportunity.
We're very lucky.
Yeah, we're very lucky that our banks were not as promiscuous, maybe that's the word, as the U.S. Banks, and that saved us.
Yeah, promiscuous is putting it nicely.
Yeah, well, thank you. Well, it's a live show, isn't it?
Right.
And PG. No, but we are a great country, and we're really strong in certain areas. So banking, we're phenomenal. Natural resources, we're phenomenal. Publishing, news, that sort of stuff, very strong. But there's areas we're not strong in. Healthcare, pharmaceuticals, things of that particular nature. Now, so like I said, for the past 10 years, it's been a Canadian story. And with some of the emerging markets thing, a lot of them are using our natural resources. But going forward, I'm not sure, all your eggs should be in that particular basket.
Right.
And if you look at where all the major corporations are, all the the Fortune 500 companies, maybe one of them is in Canada. Like there's just, most of them are U.S., international. So again, properly diversifying your portfolio is I think really one of the things that's really important.
Sure.
And there's some other areas too. So that says a lot about diversification, but there's also the whole emerging market opportunity. And I'm not sure how familiar you are with that particular.
Well, I've heard that term many times, but tell us more.
Okay, so there are opportunities out there in emerging markets that people should be taking advantage of, and these are countries that are growing much more aggressively than the developed nations like Canada and the United States. And things. So if you take a look at Brazil, Russia, India, and China, for instance. India has a middle class of approximately 200 million people that are middle class people like you and me.
Right.
That is larger than, or close to the size of the United States, but just their middle class. These people, and I have a lot of Indians who are clients and friends of mine. They all want what I want. They want a nice car, they want a house in the suburbs, and they want a good life. What's happening in those economies, these people are all getting these things, which means the companies that are marketing to these people in those areas are growing aggressively. So for instance, there's lending institution companies in India that are starting to offer mortgages in India.
Maybe I should move there.
Maybe you should move there. There's a car called Tata. I don't know if you're familiar with it. They've developed this 3-wheel car. Now, no one has a car out there. You and I wouldn't step in this thing for anything.
I think I've maybe seen it on TV.
Yeah.
I've seen the rickshaw, which is, I think it's a 3-wheel vehicle. Is this similar?
Exactly. It's $2,000. It's $2,000.
Yeah.
But what's happening is it's taking all these people from their remote districts and being able, it's repopulated.
I'd like to get one of those, drive down Bathurst Street.
Be my guest.
Yeah.
No, but actually, you know what? That there is, who knows, eventually, I mean, especially with the price of gas, and that's a whole other issue too.
Yeah.
I always get asked that, what's going on with oil and gold,
Right.
our gold, are those good positions to
Yeah,
take?
so there's some good opportunities coming out in certain countries. So it's like sort of like a diversification by international region, but it's emerging markets.
Exactly. And so if you look at this, if you look at the opportunities within these emerging markets, one of the issues too is that these individuals are a lot younger. They have a much younger demographic. They're not boomers.
Yeah.
They've got people who are becoming 25 years old. That's where the key elements of their population is. So again, opportunities, there's a huge working class there. They're all becoming very tech savvy, and I don't have to tell you about the importance of social media and the internet.
Right.
But that's where a huge amount of energy and infrastructure is going to be created.
So I have to ask you this because I'm sure people ask you this. You work for you're connected with a mortgage company who's like, obviously promotes real estate.
Yes.
So how do you answer when people say, should we be putting our money in the stock markets, or should we be buying real estate? How do you answer that?
So I get asked that a lot, and it's a great question. The truth is, and I'm going to address it from 2 points. I'm going to talk about historic returns. So historically, which is always a dangerous thing to say, the equity markets, stocks, have always outperformed real estate. Historically, it's been 10 to 12% over any 20 or 30-year period. Historically, real estate has grown at about 4%. Now, you and I live in Toronto in some pretty hot spots, and we had Gila being the ratepayers up at, in Thornhill. I know there's some very, fast-growing homes. In terms of value, depending on where they are. So I won't discount that, and I won't discount that there are real estate booms. But I will say this, that most people already have the majority of their portfolio in real estate.
That's true.
If you look at it, $1 million home in Avenue Road in Lawrence, you've got $1 million in the real estate market. And you have maybe someone has $100,000 in stocks. So already you're overweight in real estate. And a properly diversified portfolio would have a larger stock portfolio. That being said, real estate can be an excellent investment. I won't dispute that. But I am a firm believer that stocks will outperform real estate historically. That being said, I will be wrong at times, but I always take a long-term perspective. I don't know if that answers your question.
Oh, absolutely. Absolutely it does, John.
And actually at Northwood, they even have a MIC, a Mortgage Investment Corporation, and that does extremely well. And it's an excellent investment for people to consider.
Some of your clients can
look at that, absolutely. But I would say the core portfolios will be made up of stocks and bonds. Stocks and bonds,
and we had our tips today, right? Which is to invest regularly, start early, and consider emerging markets
as part of a portfolio.
Part of a portfolio. And people come to you, and you'll look at all their needs, including insurance needs. I'm sure, with all these letters next to your name, certified financial planner, and everything else.
Exactly.
You can,
exactly. And we have a team of advisors who are there to help, both on the mortgage side and the insurance and investment side. We even have a pension department. So we're there to help. But yeah, your point's valid.
You got it all. So no, we have a website here, just to mention. It's what is the website, John?
NorthwoodMortgageLife.com.
Okay. John, thank you so much for joining us.
A pleasure.
Appreciate your tips.
Thank you.
Good luck with your show. We alluded to it. What's the name of your show again?
So I run a speaking series called Toronto Talks that you've been out to.
Sure.
And we actually have an event coming up at the end of the month. But our online show is called Money Talks Media, and we talk about money. Thank you very much for having me out. It's a true pleasure.
John, you gave me my first break in the mortgage business. When I first started, I was a real newbie, and you helped me out.
Well, look what you've done.
I always remember that.
Well, look what you've done. Congratulations on your success.
Thank you very much. So again, thanks, John. You are watching Kiosk Toronto. Thank you very much for joining us. And until next time, don't forget to check in then. Bye for now.